And a very warm welcome to The Bottom Line, a wrap of the business news of the day. I'm Frances Hurd, and we start with the rand that was under quite a lot of pressure today. In fact, South Africa was caught up in the biggest drop of emerging market currencies, and of course we're part of that emerging market basket this year. Let's bring up the rand. The rand fell by more than 1% against the dollar, and remember that when this graph is generally going up, that means the rand is weakening because suddenly you need more rand to buy $1. So today, here is our weakest point, 14.56 to the dollar, ending at about 14.50 at the close of business. This comes after the central bank in America, the US Fed Reserve, cut interest rates for the first time in more than a decade. And this reaction, a weakening of the rand, not really expected. In fact, the expectation has been that when rates went down in the United States, our relatively higher interest rates would be much more attractive to investors and the rand would strengthen. What's playing out here is something different. Yes, the US cut rates, but it's also dampened expectations that this is the start of a cycle, that there will be a whole lot more cuts to come. That, in fact, caused the dollar to soar today, rising to a 2-year high, and the rand therefore weakening by more than 8%. Well, the US Fed Reserve has cut interest rates for the first time since 2008, but that failed to win over President Donald Trump. He wanted an even bigger rate cut than the 25 basis points. Our US correspondent Nick Harper has more.
This rate cut was expected. The US Federal Reserve has been signalling it for some time, but it marks a momentous shift in US economic policy, this being the first rate cut since December 2008, the time of the financial crisis. Now, in recent months, there have been signs of weakening US economic data. Second quarter GDP, for example, last week came in at a disappointing 2.1%. That's the slowest quarterly growth in more than 2 years. But more than that, the Fed seems to be reacting to the global instability. This can be seen as a preemptive move to help ease the economy in the face of continued trade disputes and a stronger dollar. The Fed trying to ease the US economy, helping it to continue to grow by cutting rates by 0.25%. And it's certainly what President Trump wants. He has attacked the Fed repeatedly over recent months. He's unhappy that the Fed has raised rates 9 times since December 2015. Now, they did so to try and even out the emergency monetary policy measures and severe cuts that it enacted during the 2008 financial crisis. But President Trump says those increases were done far too early and far too severely. He says that put him economically at a disadvantage. He pushed for a large cut. A 0.25 point is probably much more moderate than the president would have liked, but it might appease him, at least for the time being. But are there more rate cuts ahead? Some analysts are now predicting anywhere between 0.5% to 1% cut in total. Or this could be a case of one and done. There are some domestic signs that suggest the US economy isn't exactly in trouble, like unemployment sitting at a 50-year low and wages rising slowly. So they may decide that they've done enough to stabilise things for the time being.